Welcome back to the Deep Dive by Talk Tickers. Our job, simple. We cut through those long earnings calls to give you the key takeaways you need. And today we're diving into Reliance Inc. ticker RS and their third quarter 2025 results. They reported on October 22nd, call was the 23rd. And it really set up this classic tension, didn't it? Great operations, but, well, some margin headwinds that clearly worried the market.
Oh, definitely. You saw it play out almost immediately in the stock price. Despite really solid revenue, the stock actually closed down, what was it, 1.67% on the day?
Yeah.
So that tells you right there the market was laser focused. Less on the top line, more on margins and that Q4 outlook.
Okay, so let's just quickly nail down that snapshot first. Revenue looked good, $3.65 billion.
Yep. Beat the $3.54 billion consensus. That's up 6.8% year over year. So strong top line execution, great volume performance.
And then came the earnings per share. And that, I think, is what really drove the negative reaction. Non-GAAP EPS was $3.64.
Right. And the street was looking for something closer to $3.71. So a slight miss there.
So you've got this picture, strong revenue, record volumes, actually tons sold, hit a Q3 record up 6.2% year over year.
Yeah, huge volume.
But that EPS just slightly underwhelms. And I guess that mismatch is where we need to start digging.
Exactly. It leads you straight to the margins and, maybe more importantly, some accounting effects that were really at play.
So the reported gross margin GAAP basis was 28.3%. On their non-GAAP FIFO basis, it was 29.0%.
Which is interesting because, management was quick to reaffirm their long-term target. They're still aiming for that 29% to 31% range, sustainably.
So they see the current pressure as temporary.
Seems so. They pointed to mill price resets coming through and just a pretty competitive environment, especially for carbon steel. Remember those tariff-driven price hikes earlier?
Vaguely.
Well, they didn't really stick because demand was kind of soft. So that's putting pressure on pricing now.
Okay, but you mentioned accounting. That wasn't just market pressure, was it? The LIFO charge was significant.
Oh, absolutely critical. I mean, if you're looking for that roughly year to 07 EPS miss, LIFO is, it's the big piece.
How big?
The LIFO expense in Q3 alone was $25 million. That translates to about a 35 cents per share hit.
35 cents. Wow.
Yeah. And it's key to understand how LIFO works. Last in, first out, it sort of smooth things out. This Q3 expense actually reflects cost increases that happened earlier in 2025.
Okay. So it's like an accounting lag. The P&L is getting hit now for inflation that might have peaked months ago.
Precisely. It's an accounting charge penalizing current earnings for past cost hikes.
Yeah.
So if you kind of mentally back that out, the core operational earnings look healthier than that $3.64 headline. And
management knew this was coming, right? It wasn't a surprise charge.
No, not at all. They flagged it. They expect the total LIFO hit for the full year 2025 to be around $100 million. So another $25 million is baked into Q4. It's known.
Okay, let's put the accounting aside for a second then and talk operations because, like you said, volume was huge, record Q3 tons, up 6.2%. How did they pull that off when the broader industrial economy feels kind of sluggish?
Market share gains. Plain and simple, their shipments grew way faster than the overall industry, something like 9 percentage points faster.
9 points, that's substantial.
It really is. It speaks volumes about their strategy execution.
And it pushed their U.S. market share up quite a bit.
Massively. From 14.5% in 2023 up to 17.1% now. It's a huge jump. They call it their smart, profitable growth strategy.
So how are they doing it? What's the mechanism for stealing that share? Is it just price?
It seems to be more about service and value add. They've really leaned into expanded processing capabilities, cutting, shaping, whatever the customer needs. About half their orders now involve some processing.
So they become more integral to the customer's own process.
Exactly. And they're focusing on those just-in-time needs, especially for smaller customers who maybe don't want to hold much inventory themselves right now. Reliance effectively becomes their warehouse and processor.
Makes sense. That volume surge feels like a strategic win then. But the question is always durability, right? Are these customers going to stick around when things normalize?
That's the million-dollar question, isn't it? Management thinks so, banking on the service model, creating stickiness.
Yeah.
But the other benefit, right now at least, is the operating leverage they're getting.
Oh, so?
Well, all those extra tons help absorb overhead costs. If you look at their same-store SG&A expense, but on a per-ton basis,
Okay.
It was actually slightly lower than last year.
Wow. So the growth isn't just empty calories, it's actually improving efficiency, textbook leverage.
Exactly.
Okay, but let's connect that strength back to the end markets because this seems to be where the caution, the thing that maybe spooked the market, really comes from. It's not strong everywhere.
No, definitely a mixed bag. The big chunk, about a third of sales, non-residential construction, that's still quite healthy.
What's driving that?
Think data centers, lots of public infrastructure, schools, hospitals, airports, and just ongoing manufacturing facility build-outs. Defense and space are also holding up okay.
But, and there's always a but, the high margin specialty stuff.
Yeah, that's where the headwinds are biting. Commercial aerospace, about 9% of their sales in semiconductors, those are the pressure points.
Still inventory issues.
Exactly. Ongoing excess inventory, destocking all through those complex supply chains. Management actually pointed out that most of the margin squeeze they've seen since May is tied to less than 10% of their total sales.
Right.
But it's that really high value, high margin 10%.
Right. Did they give any sense of timing? When might that destocking ease up?
They used a baseball analogy, which I always find interesting.
Huh, okay. Seventh inning stretch.
Sort of. They think their own aerospace inventory is pretty well managed, maybe in the seventh or eighth inning, as they put it.
Okay.
But they caution that the overall industry, their customers, might only be in the fifth or sixth inning.
Ah. So improvement, but maybe slow and steady, not a sharp snapback just yet, more of a 2026 story for a real acceleration.
That seems to be the implication, yeah.
Yeah.
Gradual improvement through the rest of this year and into next.
Which brings us neatly to the Q4 guidance. This was the other piece that seemed to weigh on the stock. What did they actually forecast?
Well, for tons sold, they guided down 5 to 7% sequentially from Q3.
Which sounds bad, but is that normal for Q4?
Totally normal. That's just seasonality. You always see a dip in Q4 because of holidays, fewer shipping days, plant shutdowns. It's expected.
Okay. In pricing.
They expect average selling price, the ASP, to be relatively flat compared to Q3. So volume down seasonally, price roughly flat.
Which leads to the EPS guide of
$2.65 to $2.85 for non-GAAP EPS in Q4. And critically, that range includes another $25 million LIFO expense, just like Q3.
Right. So if you look at that $2.65 to $2.85 range, how does it compare historically to the Q3 to Q4 drop?
It's right in line. Historically, their sequential decline from Q3 to Q4 is typically in that 20% to 25% range. This guidance fits that pattern perfectly.
So the market may be overreacted, treating a normal seasonal dip plus that known LIFO charge as some kind of new operational problem.
It certainly looks that way. The reaction seemed harsher than the underlying reality of predictable seasonality and accounting effects.
Okay, so for you, the listener, trying to make sense of this, what's the takeaway? Let's synthesize the so what, maybe starting with their financial position. Still solid.
Extremely solid. Balance sheet is a major strength. Their net debt to EBITDA ratio is less than 1. That gives them enormous flexibility.
Flexibility for what? Buybacks, M&A.
Both. They were active on buybacks. In Q3, spent about $61 million buying shares back at an average price around $287.71.
$287? Okay, good reference point.
And they still have almost $1 billion left on their buyback authorization. So management clearly sees value at certain price levels.
And M&A. Any signals there?
Yeah, commentary was pretty positive. They said deal flow looks steady and valuations are, quote, generally reasonable. So expect them to keep looking for bolt-ons.
What about spending on their own facilities? CapEx.
They're signaling maybe a bit of a slowdown there. They expect cash CapEx in 2026 to be directionally lower than the $325 million budgeted for 2025.
Yeah.
Focus seems to be on getting returns from recent investments, though some carryover spending might keep the final cash outlay similar next year.
Got it. So key things to watch in the coming quarters. Obviously, metals, prices, right? They mentioned plate hikes, beam lead times.
Yep, keep an eye on those. And the big one is that inflection point in aero and semi-destocking. When does that turn?
And can management deliver on stabilizing those FIFO margins in Q4, like they suggested? Flat to slightly up?
That will be a key proof point for sure.
All right. This all sets us up nicely for our final segment. We take everything we've just discussed, the LIFO, the market share, the seasonal dip, and spin out an outrageous but plausible trade idea. And just to be crystal clear, this is analysis based on the call, absolutely not financial advice.
Right. And the setup is really that the market seemed to punish the stock for things that were either temporary, like LIFO, or predictable, like Q4 seasonality.
Exactly. So here's the pitch. The underlying story here is incredibly strong, right? Gaining that much market share from 14.5% to 17.1%, massively outpacing the industry while holding the line on long-term margin goals. That's powerful execution.
But the stock got dinged because of a normal Q4 dip and an accounting charge.
Correct. And the real pain point, those specialty markets, management themselves says they're in the late innings of destocking, at least internally. That suggests the highest margin part of the business could be near its trough.
Okay, so the trade idea.
The trade is going long right around now, using this expected Q4 seasonality as your entry point. You're essentially betting that Q4 marks the bottom, fueled by temporary factors, and you catch the rebound into Q1 2026.
And the plausibility hinges on a couple of things.
Right. One, do those market share gains stick? If they do, driven by service and processing.
Which management seems confident about.
And two, if those profitable aero and semi markets finally start restocking properly in Q1 2026, then that temporary margin pressure we saw just evaporates.
And earnings could accelerate pretty dramatically off that Q4 seasonal low.
Exactly. Potentially driving the stock back up towards that level where management themselves were buying back shares, that $287 mark. That's your plausible target based on their own actions.
Interesting angle. Leveraging the predictable dip.
So wrapping this deep dive up, Reliance looks like a company executing its operational playbook really well, gaining share, hitting volume records, but caught in the cross currents of LIFO accounting and normal seasonality for now.
And maybe a final thought for you, the listener, to mull over. That jump from 14.5% to 17.1% market share is huge, but you should really consider how durable it is. Was it all service and value add that competitors can't easily copy? Or did aggressive pricing play a role during volatile times? Because the answer to that will really determine how stable their margins look once pricing settles down in 2026.
Great point to chew on. Okay, that concludes our deep dive on Reliance Inc. Thanks for joining us, and we'll catch you on the next Talk Ticker Summary. Remember, none of this constitutes financial advice.